I mean, just in the past couple of business days, we had Austin Goolsbee this morning. We had Mester non-voting, but Mester earlier today. We had Williams last
Williams
week.
On Friday. Yeah, everybody's walking it back.
Everybody's trying to walk this back.
Right.
What's the purpose of that? Was it a mistake that he was way too dovish?
Yeah.
I
mean, I think that, obviously maybe certain parts of the market have gotten ahead of themselves. And what's priced in right now is, I think, like 140 basis points of cuts next year, which is probably not achievable. I mean, our economists are looking for maybe 100. I do think that the reason to own equities is not because of what the Fed is going to do next year. The reason to own equities is because of what the Fed has already done. I mean, think about it. We're in a normal market environment now. We have real rates that are at kind of reasonable levels. We've got 5 percentage points of latitude to ease our way out of the next recession. I kind of don't care as much how many times the Fed cuts interest rates, and I know that sounds like heresy because we're all watching the Fed with bated breath.
But it sort of is because, I mean, we've seen such a huge move after this pivot, this major pivot that Powell gave to us.
We saw a move, but yeah, you're right.
He could have been wearing a Santa Claus hat that day. I mean, basically, he is going to be the reason for the rally into year end.
Well, but there was already a pretty strong rally into year end before that. So I think that, maybe he just threw a little gas on the flames, but my sense is, we're not necessarily betting on a super accommodative Fed next year. I think you can still own equities even if the economy is continuing to grind higher, even if we get a little bit of a resurgence in inflation. I think goods inflation would actually be a positive for, the S&P.
So, Savita, since I've been in the market since 1997, there's been 3 instances where the Fed has cut interest rates, and never has it been something of just a casual effect. Okay, I'm just telling you. So when they have cut, they have cut aggressively
because of something going wrong.
Correct.
Yes.
And so in 2000,
so we should never want the Fed to cut interest rates. Actually,
but they just told us there's a good chance of it. They just told us Fed funds is pricing it in. They're pricing 140 basis points of cuts. I mean, what are they seeing?
Well, the dots.
Back to what I'm talking about.
The dots tells you what they're thinking.
So what I'm saying is like it would be very different this time that when they start to cut, they don't have to use a good part of that 5% or 5.25% that they've been raising over the last 2 years or so. I mean, so to me, I just think if you're here and you're YOLOing equities because everything sounds great,
have at it. Have at it. Maybe
one could have at it, Tim. Or you might take a step back and start to think a little bit critically, because as much as the recession was priced in this time last year, right, where the market was trading, it's priced the other way right now. And to your point, you used the term complacency. So I just think we can see how things kind of shape up in the new year before we kind of get all geeked up about stuff.
Well, maybe this time is different, though. Aren't a lot of things different about this time? I mean, but there are a lot of things that are different today than there have been historically. I mean, if you think about the easing and tightening channels for credit, it hasn't been banks, it's been shadow lending. If you think about the Fed balance sheets, we're at unprecedented levels
in the shadow banking system.
I mean, I think that there are risks, but they're not necessarily in public equities. I'm just saying there's a lot that's different this cycle. Like, look at the Fed balance sheet. It's very different from all of the prior, cycles that we've
much bigger.
It sounds like you're thinking that it's much different in a worse way.
Yeah.
Right?
Yeah. Well,
I think it's worse for the Fed balance.
Yeah. Private credit is going to be a problem.
Right.
Obviously.
So the transmission mechanisms are different.
Yeah, I mean, look at what kind of worked its way into it this time, right? The Fed was still involved in quantitative tightening when we had the regional banking crisis, and they pulled off, something of triple Lindy or something like that, and just think about it. Like,
we need to do a PSA on what the triple Lindy was, by the way, straight out of old school. This is Rodney Dangerfield, et cetera, et cetera. But we're at a place where, Savita, one of your strong arguments is that old economy stocks are poised for an earnings renaissance based upon productivity gains, and that's part of the dynamic. We've had an earnings recession. Forget the economy. We've had an earnings recession. And your peers around the street, whether they be strategists, whether they be quants, are saying we see, in fact, the street's got 10.5% earnings growth in 24.
Yes, absolutely.
And is that where it's coming from? Is it coming from these old economy stocks? Because I own a few, and it hasn't been a good run.
I think it's coming from a little bit of everything. And you're right, it has been miserable to own old economy stocks this year. But if you think about it, those are the companies that can benefit from a lot of these new tools, these productivity enhancements, AI. I mean, AI isn't just about semiconductors and software. It's also about old clunky companies becoming lighter, labor lighter, and you know, getting a little bit leaner and getting some margins. So I think that this is the time to own old economy, and we've already seen that broadening out of performance. I think since the beginning of November, the equal-weighted S&P has outperformed the cap-weighted S&P, not by a huge amount. So I think that next year you start to see more of that broadening trend.
Yep.
By the way, that was the worst definition of triple Indy ever.
I'm sorry.
It was from Rodney Dangerfield.
Yeah, old school. Back to school. Back to school.
Back to school.
All right, Old School is a different movie, and of course that's that's Will Ferrell, and
Anyway,
also a great movie, by the way, and I think we need to have more references to that on this show as well. Back to School, Rodney. Yes. All right.
Back to the topic, though.
Thank you.